Welcome to Sovereign Finance, the show that connects the dots between personal finance, global finance trends, and deep human history. Tune in every week to demystify the money puzzle and protect your interests in a turbulent world. Our topic today is inflation, and I was thinking just before that this is a topic that I think everyone is aware of. We're all aware of rising prices, and in recent years it's been rebranded as the cost of living crisis. But I think when we scrape down on it, the question is why. I'm aware that prices are going up. I became aware recently that perhaps my salary or my earnings weren't inflating at the same rate as some of my other expenses, and I have this feeling that that I'm being manipulated in some ways. So I thought we could dig into that topic today.
Yeah, absolutely. I was aware of it as a child because there was one of the sort of recurrent background conversations when I was a child was before the war. And before the war, things were like this. And before the war, things were like that. And one of the things that I was told was that a 2 ounce bar of chocolate had been 2 pence before the war. These were the old pennies where there were 12 pennies in a shilling and 20 shillings in a pound. So that was a 240th of a pound, not a hundredth of one. Anyway, a bar of chocolate cost 6 pence in those days, 2.5p in today's currency. And I was told that the 2 ounce bars of chocolate were 2 pence before the war. And I remember asking adults, well, why are things more expensive? And the closest I got to any kind of answer was, well, things do get more expensive when there's a war. Of course, we could go into that, but it's because a lot of money gets spent for no productive purpose at all, and in fact, quite the reverse. But that's maybe a topic for a different day. And so I was aware of this, but I also noticed a little while later that very, very slowly prices were creeping up, and often it was disguised. Well, one time I remember I went to the shops and I'd been sent to get half a pound of digestive biscuits, and I asked for that, and the shopkeeper said, well, just in case your father's the weights and measures inspector, I have to tell you that this packet isn't strictly half a pound of biscuits, it's 7.5 ounces. And I thought this was an odd thing for him to say because, in those days, everybody knew everybody. And he knew perfectly well that my father was a sales manager at an agricultural merchant and that he wasn't a weights and measures inspector. It was obviously his rhetorical flourish. But the point is they'd managed, and I thought, well, who cares? It's about the same size as I remember. And that's presumably what everybody else thought too. But in fact, it was a sneaky way of making it about, what would it be, 7 or 8% more expensive without actually changing the price. And a little while later, I noticed the same thing was happening to the bars of chocolate. They used to have 2 Oz, meaning 2 ounces, in big gold letters on the front of the label. And a year or so later, I noticed that it didn't say that anymore. And to find out what the weight was, you needed to turn it over and look at the very small print on the back of the label, where it said it was 1 7/8 an ounce or whatever it was, or something in grams, which made no sense if you've been looking for how much it was in ounces. And so this has been going on, but it was still pretty modest all through the 1950s and the 1960s. And then, of course, as the 1960s progressed, it gradually began to creep up, and came to creep up in the news. And there were various stories about, what was the reason for this, and most of the news items said it was because of the trade unions demanding wage rises, and this was pushing the price of everything up. But we'll get a bit later on into the conversation and see if we can uncover, what the real driving force is.
Because sometimes hyperinflation gets talked about as well, and I associate that with Argentina and some of these places where you go to the shop and the price of bread is doubled in the time that you're there. I mean, I think that's also what people perhaps think of when you talk about inflation.
Well, hyperinflation just means a lot of inflation, but it's also when it's accelerating in an uncontrollable fashion. And you mentioned Argentina. I think the main classic ones have been obviously Germany in the Weimar Republic in the 1920s, and Zimbabwe right through the 1990s and the early 2000s. So, when effectively, there are, as you said, all these absurd stories. From Germany, uh, the, the the currency would have inflated from the beginning of a meal to the end of it. And there were stories, I don't know whether they're apocryphal or not, of people having a wheelbarrow full of million mark notes and leaving it and coming back to find that somebody tipped the banknotes out of the wheelbarrow and stolen the wheelbarrow because it was worth more than multi millions of marks. Effectively, all of these things happened when money was printed at a great rate. And I still don't know to this day whether the German central bankers who ran that did it out of some sense of naivety, or whether they did it deliberately to devalue the mark ahead of the reparations that had been imposed on them by the Treaty of Versailles.
Well, surely it was deliberate. If your currency is all in paper money, then you've got to go and deliberately do that. Like it's far easier to expand the money supply when it's at least a partly digital currency, I think.
And of course, we've had an enormous increase in the amount of money in circulation, particularly in the United States. But because the dollar's a reserve currency, that has fed through to everything else in the world. And recently, particularly since the 2008 banking crisis, there's been a plausible story in the media as to they don't call it inflation, they call it quantitative easing.
Mm-hmm.
And there's been various things, and they plainly can't stop. There have been one or two attempts, and of course, as soon as they attempt to do this, the stock market begins to look very shaky, which is a public relations disaster for the government, and also the government interest, the interest on the government bonds uh, starts to move up. They've only been able to keep those interest rates down by piling more and more currency into the system. In a way, the cost of borrowing money is like everything else, to some degree, a question of supply and demand. And if you keep on adding to the supply, it prevents the price from rising. But the moment the supply looks like stabilizing, if the demand is going to go up, the price is going to go up. And the price of borrowing money is, of course, the interest rate that you have to pay on it.
But perhaps they keep expanding the supply because the system basically will collapse if they
Yeah,
don't.
yeah. One way or another, it is going to collapse.
So before before we address that, bringing it back to you going to the shop and the price of bread increasing, there's I think a perception that hyperinflation is obviously bad. We don't want hyperinflation, but then a degree of inflation is presented as good because, in theory, that indicates economic growth and the fact that trade is happening and so on. So the target rate in air quotes is 2%, and I wanted to unpack that. Like, why is that?
We're told over and over again that the target rate of inflation is 2%, so this is a self-evidently desirable thing. Uh, in fact, there's absolutely no reason why the target rate should be anything other than zero, because a zero rate of inflation would mean that the currency was stable. And also, the term inflation is really a a misnomer when it applies to everything across the board, which it does at the moment. Really, what it is it's a disguised way of saying that the value of the currency itself is being debased. And this is something which is a recurrent feature throughout history. When the primary currency was gold or silver coins, they were debased either by people in the population in general shaving bits off the edge or clipping bits off the edge, or by the ruler who was the issuer of the currency trying to balance his books by either uh, reducing the weight of the coins, or more often by alloying the gold with usually silver, so that it wasn't too obvious, so that there was less content. And I mean, this is what happened, for instance, in the Roman Empire. The silver denarius, which was the principal uh, coin of the Roman Empire, which was originally struck about 269 BC, by it was stable for a while, and then in the early centuries after Christ, in the early years after Christ, it had fallen to about half that, and then it fell again to something like three quarters of that value by the final years of the Roman Empire, and this was the ruler's way of continuing to be able to pay out the expenses of running the state with a diminishing revenue.
It feels like kicking the can down the road, and
It is,
eventually there is going to be no more road. And
yes, yes, and that's what has been happening. Now, I mean, it took oh, nearly 500 years for the for the Roman denarius to fall to about a third of its value. The and the same thing happened with the Spanish currency at the end of their empire, the Dutch currency at the end of their period of ascendancy, the British pound. I mentioned about the clipping of coins, and of course the introduction of forgeries into public currency. And that was the situation when Sir Isaac Newton was made Master of the Mint and then Warden of the Mint. And a lot of people regard this as being a kind of twilight period in Newton's life, when, after having his enormous breakthroughs in mechanics and gravitation and optics, he settled for having a sinecure to give him a comfortable old age. But that wasn't the case at all. He was very energetic, very committed, and he realized that the British currency was in a terrible state, and he really took that on in a way that wardens of the mint generally didn't. They were generally quite happy to put their feet up and take their generous salary. He pursued forgers and counterfeiters, and he masterminded calling in all of the sovereigns in circulation, uh, melting them down, purifying them, and recasting new sovereigns. And these maintained their value from the late 1600s when he did that, right through to when Britain took itself initially off the gold standard at the beginning of the First World War. And of course, that was a period of astonishing prosperity and astonishing growth in prosperity uh, for Great Britain, which I think gives the immediate lie to any assertion that inflation is in some way beneficial.
So economic growth actually is encouraged by having a stable value to the money rather than it being debased for short-term gains by those who control the money supply.
I would say that was demonstrably the case from, for instance, that one example. Quite probably Britain would never have managed to pull off the implementation of the dramatic industrialization of the country without a stable currency. Neither would they have established a worldwide trading empire. Uh, and once again, in more recent times, at the end of the Second World War, we had the Bretton Woods Agreement, whereby all of the currencies of the world were tied at fixed exchange rates to the dollar, and the dollar itself was defined as a 35th of an ounce of gold. And that that was a period which certainly saw huge improvements in prosperity in Britain, in Europe, and most of all in the United States. So once again, and again, it's a matter of common sense. If I'm trading with you, I want to know that if you promise to pay me for goods, that the price we've agreed on is going to carry the same value when I deliver the goods a month or two later as it does today. And that stability began to erode uh, towards the end of the 1960s, simply because other countries in the world had not had the same degree of uh, economic activity that the American economy had, so they were worth less in dollar terms. And that was when, first of all, we had a round of devaluations against the dollar, and then a short while later, the 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 market became more fluid, whereby currencies were exchanged at various rates according to supply and demand. But of course, that introduces problems of its own, because once you have markets setting currency exchange rates, you have people coming in and attempting to speculate on the movement. And of course, this and now I don't know the exact percentages, but it's something like 95% of all currency exchanges are not made, for example, to pay for goods in another country, uh, but for speculative purposes. And of course, like any form of gambling, this is a zero sum game, because the only way that somebody's going to make a profit is at the expense of somebody else making a loss. Plus, of course, there are trading costs involved. So, in fact, it's a net negative sum game.
Is it desirable then to kind of just have one currency? Because obviously you then remove the trading and gambling aspect of it, or does that place a risk that whoever controls that currency is going to debase it and destabilize the whole world?
There's two separate questions there. I mean, the first one of those is how could we avoid having anybody in control of it and therefore able to manipulate the situation?
Because you want to decentralize things. If there's just one group of people who control it all, then that's not going to create the terms of fair trade and fair value exchange.
No. Well, but to answer the first part of the question, is it desirable to have a world currency? I would say absolutely it is. I would say, just the same as every country historically had their own systems of weights and measures. And that didn't matter too much when the majority of your transactions are going to be within your own country. You had feet and inches here, you had various other measures in other countries. After the French Revolution, they introduced the decimal, um, the metric system, meters and kilograms, and this has now gradually become the standard throughout the world, which, given that now we're buying and selling internationally, that makes perfect sense. I mean, the it's ironic that the one holdout against that is the Americans, and they've managed as a result of that to get one of the Martian landers 6 million miles to Mars and then crash it into the surface because it turned out that one of the engineers had been working in metric units and the other had been working in imperial units.
Oops.
Yeah. Anyway, so I think I am certain that by the end of this century, assuming we have a human society at all, there will be one global currency.
Well, it's just crazy otherwise. It's like going from England to Wales. It's like being in Shrewsbury or Chester or somewhere and then going over the border to Wales and having a different currency and having to. It's crazy.
Yeah, and of course there's an overhead every time you change it, which kind of made some sense when you were actually handing over pound notes and getting franc notes or lira or something, because they've got to actually do something. Now you still get the similar commission charges and spreads on the buying and selling price, even though all that happens is that the bank just simply writes it into a different ledger.
So, who benefits then from us having a degree of inflation, and who are the people who are losing out?
Well, we've already touched on the fact that the cost of government borrowing is being held down by inflating the money supply because it holds the rate of interest down. And governments, particularly the American government, is so enormously in debt. I think it's over the government debt is over 200% of the actual gross domestic product of the country, which is an unsustainable situation. Once again, it's one of these things which is going to compound as it begins to unwind. The other thing is that plainly it benefits the bankers. The I mean, and one thing I should mention here is we've talked about central banks controlling the currency, or we've implied that that's the case. In fact, regular retail banks are in fact themselves generating money out of thin air. As far back as the 1930s, John Maynard Keynes once remarked something along the lines of the process by which banks create money is so astounding that the mind reels in amazement. And this is the answer, that they create money simply by when they advance a loan to somebody, they they simply create a bookkeeping entry, and they they create two bookkeeping entries. One is the liability of the customer to the bank for the value of that loan, and the other is the asset of the bank, which consists of the loan by the customer. This is at root. This is called fractional reserve banking, and the idea going back to what banks did was provide a safe deposit store for gold, and they issued receipts for the gold, and people and these receipts were often bearer documents, which meant whoever held the receipt could go to the bank and claim the gold. And then the practice grew up over time that when somebody made a sale, the buyer would give the seller the receipt from the bank for his gold. And theoretically, the person who'd sold the goods could go to the bank and then get the gold. But since he could just as easily use that note to purchase something from somebody else, it was more convenient to simply hang on to the bearer certificate and use that in trade. And that's how the use of banknotes grew up. And I think, as I mentioned in the last talk, giving an overall summary, when I was young, uh, the £1 note said I promised to pay the bearer £1 in gold, even though strictly speaking that wasn't true, and it hadn't been true since Britain took itself off the gold standard in 1933. But you could at that time actually change your pound note for $2.80, and you could get $2.80 worth of gold. So it was remotely tied to it. Now, if you look at a banknote, it says I promised to pay the bearer on demand the sum of £20 or whatever value the note is, and this is of course a meaningless statement. You could take your £20 note to the Bank of England and say, I want you to give me £20. And what are they going to do? They could give you another £20 note. They could give you two £10 notes, or they could give you four £5 notes, but they're not going to give you any gold. And now you can't get the gold from the American Treasury or the Federal Reserve either.
So if they're creating money out of nothing, and this is happening all the time everywhere,
Yeah.
how are the official inflation rates calculated, and can they be trusted?
Well, exactly. I mean, what we're told is because the public discourse about inflation is that what it means is rising prices. They have this gathering of statistics where you have some basket of goods, as it's called, which is supposed to be a typical person's purchase. And they calculate, they go around, they see what the supermarkets are charging for bread and potatoes and milk and so forth, and add them all up. And then they say, well, it's gone up by this percentage. But this bears no relationship uh, to the fact that the currency itself is falling in value. I mean, the term inflation, it might make sense. Suppose, for instance, you had a resource like, for instance, coal, and as time goes by, the coal mines get exhausted. You have to sink deeper shafts. You have to dig out far more slag to get a certain amount of coal out of it. The quality of the coal's going down. You could talk about the inflation of the price of coal in that instance. That would make sense. But where everything across the board is going down, as I said, the honest way to describe this would be by as debasement. And I would say that the I would say that using gold as a metric was as good as anything. And as I've mentioned, the British pound was stable at around about a quarter of an ounce of gold. That's about 8 grams from 1690 up to 1914. By 1930, when they threw the towel in and came off the gold standard, it went down somewhat. The dollar itself was also devalued in terms of gold at exactly the same time, and probably for the same reason, because this was to pay for the expenses involved in the wastage and the destruction of that was used in fighting the First World War. And then at the end of the Second World War, the value of the pound went down again, and since then it's gone down to a tiny fraction of that, and now it's down to about 20 milligrams of gold. So it's fallen by a factor of 400 since 1914. But getting back to um, who wins and who loses. We talked about the sort of direct profit to the banks by creating currency, and the reason why this is going exponential is that as soon as a bank advances a loan to somebody, that loan then goes into that person's account, and whatever they do with the money, it's going to go into somebody else's bank account. So so that now represents a greater, since that is an asset to the bank. If the bank is allowed to advance, that becomes part of the bank's reserves, and the loans that a bank can carry are some percentage or another, which varies from time to time and from country to country. But it may well be that if the bank has got £1 million in its reserves, it can advance loans of £20 million. Well, this made some kind of sense when those reserves were actually something tangible like gold, which was fairly static. However, if the loan which has been advanced becomes either their bank's or another bank's asset base, then they can loan a multiple of that. And that is why the amounts of loans in circulation have been increasing. And so the answer is that apart from the direct result of the banks increasing their asset base by creating money out of thin air, they're also increasing their income because they can charge interest on that. And of course, the interest is really, in a way, a form of taxation on the population at large. And we could touch on the fact that as we know, house values have skyrocketed over the past few decades, and now bear no resemblance, no connection whatsoever to the cost of building the house in the first place. And this is a direct result of the fact that the loans are now advanced by banks, whereas home loans up until I guess it was the 1970s, or it may have even been the 1980s, when um, building societies were either taken over by banks or changed into banks. And once again, there was a plausible story put out in the media as to how this was advantageous to people. It was told that it would be convenient to get interest on your current accounts, which you could have if you had a building society account, and that didn't last long. And it was told that it would be very convenient to be able to have a checkbook to run your building society account rather than having to have a passbook where you go in into the branch and they write out in longhand what your current balance is when you put some money in or take it out. Uh, and there were various other stories. And of course, they were told that the people who had deposits in building societies could change those to shares and they'd get an immediate windfall. And of course, most of the members of the general public who had who exchanged their balances in the building society for shares in the newly created bank fairly quickly sold them. So all of those have ended up in the hands of financiers. But this was because the concept of a bank in the general public's mind is somewhere where you store your money, which is not even strictly true. When you put your money in the bank, it's no longer your money, it's now the bank's money, and you're an unsecured creditor of it. You're pretty much last in line if the bank goes bust. But their concept is it's somewhere where you store your money and somewhere where you've got a convenient method of making transactions. Whereas the crucial difference between a building society or savings and loan, as they were in the United States, a building society and a bank, is that the bank, as we've just described, can create money out of thin air, whereas a building society could not. it had to balance its ledgers such that the money it was lending out was only the money that savers had put in. And it's quite interesting. I didn't think about it at the time. Well, I didn't realize these things at the time, but I remember once going in and talking to my bank manager when I'd gone in to discuss my affairs at the branch. And it was at the time when the banks were beginning to get into the mortgage business. And I remember it's striking because I look back on it and it shows me now that this guy who was managing the bank didn't understand how banking worked because he said in a slightly puzzled way, I can't understand why we're getting into the mortgage market. It makes no sense to be borrowing short and lending long on the basis that people are putting in money on deposit at the bank and that's what's being loaned out. He didn't seem to realize that what his own company was doing was actually making this money up. And that is what has fueled the escalation of house prices.
And this has to be hidden, doesn't it? Because if people realise this, it would remove all trust anyone has in the currency, I guess.
I guess so. And of course, the other thing in terms of who wins and who loses, which gets back to why they might be inclined to fudge the statistics, is that certain things like old age pensions are calibrated against inflation to make them fair. Well, of course, if the inflation is understated, that's a way of steadily eroding the value of the pensions. Another reason is that if we told the public honestly that there's 10% a year inflation, there would be a lot more pressure for 10% wage rises to at least hold people in the same place. And by telling people that there's 2% inflation, if they believe that and you give them a 2% rise, they're going to feel, oh, well, I would have liked a bit more, but I guess I'm not getting worse off. Whereas, of course, everybody has been steadily getting worse off. Similarly, if you're holding your assets in terms of cash or bank account deposits, the value of those assets is going down. Even if it were only 2%, it would halve in 35 years, and if it's 10%, it halves in 7 years. And on the other hand, the people who own tangible assets like land, real estate, uh, shares in corporations that are going concern, and so on, actually hold on to the underlying value of those assets, while the assets of the general population are declining in value.
I remember being taught in economics that one of the ways that a government, say, could control this was with interest rates, for instance. So, like monetary policy. And I wondered if we could unpack that because that is observable. I think at the moment, the fact that interest rates have gone up in tandem with an appearance of more inflation. What's the relationship between the two?
Well, it's one of these things which is kind of circular, particularly as a large amount of people's outlay is on mortgages or rent, and so if the interest rate goes up, they have more outlay. In theory, the idea is that if the interest rates go up, people are less likely to borrow money and more likely to save it because they'll get the benefit of the higher interest rates. This has been decoupled somewhat in recent years because very few savings accounts anywhere provide any significant rate of return. And once again, when rates were more genuinely market driven, if there was a percentage, if there was a perception that the, that there was a certain rate of inflation, people would want interest that was at least that amount of uh, inflation added to some real return. Does that make sense?
It does, yeah, yeah. And I think this was always one of the. I remember writing essays when I was an A-level student about the pros and cons of like adopting, say, the euro in the UK and removing the ability to adjust interest rate was one of the things that we used to write about.
Well, in fact, it's not just the ability to it's not just the ability to to alter interest rates independently of, say, Germany or France, but it's also the ability to adjust the value of the currency in relation to trading partners, which is the motivation of governments everywhere to have control over the level of their own currency.
So I guess in summary, what we're saying is that most currencies around the world are being debased at a rate that is not visible. Perhaps in the perhaps in the increasing prices that you're observing in the supermarket, say for groceries, the actual value of money is decreasing a lot faster.
Yeah.
What steps can people take? Is it a case of just being aware of this, or are there things that you can
Well,
do to?
the first step is obviously to be aware of it. Um, the second step is to hold your assets in the form of something that you think has some intrinsic value. Once again, I need to emphasize that we're not giving people
Sure.
financial advice here, but I'll ask them to go away and do their own due diligence. But a house is a house is a house, so it does have some value regardless of what nominal price in the marketplace.
People have always buried gold, though, in times of uncertainty. So you get these hoards of gold, or around the end of the Roman Empire, there were people would bury their gold and forget where they've hidden it, or
They've
they
got
retreat
build up.
further back, and someone 1,000 years later finds this hoard of gold, but it's because people were stashing it.
Yes, I mean, gold is something that you could have a great deal of confidence. People will always accept in exchange for something that they've got and you want. Uh, so, so that is one. Obviously, the price of gold fluctuates because, once again, the amount that of gold that is being used to actually trade with is dwarfed by the amount which is being bought or sold on the expectation that the value is going to go either up or down uh, in the short term, and that's why it fluctuates. And the same applies to cryptocurrencies. I think we'll have a whole session or two on those, but once again, Bitcoin and other cryptocurrencies, uh, obviously the value fluctuates, but on the other hand, undoubtedly the overall trend is being up and up. And this is because, even to a much greater extent than any other currency, far more of the trading of Bitcoin is speculative. It is on the basis of somebody's judgment that the price is going to be greater tomorrow, and somebody else's judgment that the price is going to be less.
I know people who do that as jobs, like that is currently their career. I'm like, well, yeah.
Yeah, I know people who have made substantial profits by doing that, but it's quite easy to make substantial profits in a trending rising market. You know, as long as you haven't staked more than you can afford to lose if your judgment turns out to be mistaken.
Mm.
Uh, and that's a whole uh, area which is a skill in itself. Once again, it's a zero sum game, but just as dice might be a game of pure chance, whereas poker is partly a game of skill. Uh, Speculation is obviously, to some degree, a game of skill and knowledge and insight.
But I guess the point is that you can't just write more gold into a ledger and have it appear out of thin air, and it's the same for cryptocurrency. I think.
Yeah, yeah. Well, that is the point, particularly about Bitcoin. There's a bit more of a question about whether some of the other blockchain technologies really provide the same degree of stability, but there is a hard limit on the number of Bitcoin in circulation, and that limit hasn't actually been reached, but it is very close to being reached. And increasingly, the Bitcoin miners, as they're called, the people who run the generations of the next block in the chain, are going to be gaining their income not from generating new coins, which was the reward system in the early days, but by charging fees for maintenance of the transactions.
Very good. Is there anything else we should have talked about in regards to inflation?
Oh yeah, there's just one other thing I was going to say about why they would lie to us with the statistics. It's because, and we'll get on to that in the next topic on GDP, but given that once again it's stated over and over again that economic growth is good, and therefore everybody should feel better if we're getting economic growth. I mean, I'm surprised. I mean, well, we'll talk about that in the GDP session, which I think will be the next one.
Cool. Well, we'll pick up on that next time. And yeah, thanks for your time, Derek, and we'll see everyone listening on the next episode. Thanks for listening to this episode of Sovereign Finance. For more episodes, transcripts, in-depth articles, and community, please take a minute now to subscribe free at sovereignfinance.substack.com. See you next time.